Silver just crashed, the miners are down 35% from their highs, and right now, one of the most respected institutional money managers in the country just started buying back in. Most people watching those red numbers on their screen are scared. They should be paying very close attention instead, because what is happening in this market right now is not what it looks like on the surface, and the gap between what the paper market is showing you and what the physical market is actually doing has never been wider in modern history. Welcome back. If you are new here, this channel exists for one reason: to show you what the data actually says, not what the headlines want you to believe. Hit that subscribe button right now, because what I am about to walk you through is not on any mainstream financial channel today, and it directly impacts every ounce you hold. Let me start with the numbers. As of this week, spot silver is trading at approximately $71.62 per ounce. Gold is at $4,623.93. The gold to silver ratio sits at roughly 64.6 to 1. Write that number down. We are going to come back to it. And here is what should be making every serious precious metals investor stop and think. Silver ran from under $30 to over $120 per ounce in 2025, a 135% surge in a single year. It then crashed back to the high 60s. And in the exact same window, COMEX registered silver inventory dropped below 100 million ounces for the first time in years, with a single-day withdrawal of over 3 million ounces recorded in February alone. The price crashed. The physical demand did not. Let me say that again. The price crashed. The physical demand did not. Now, I want you to understand something before we go deeper. I watched an interview this week with Ted Oakley, the managing partner of Oxbow Advisors, 49 years in this business. This is a man who sold the majority of his firm's silver position at the highs near the end of 2025 and the very first days of 2026. He took heat for it. He was right. And this exact week, he started buying back, not all the way back, selectively, surgically, but he is buying. And the reason he gave for doing it is the same reason the data has been screaming for months, and the same reason most retail investors are staring at the red candles right now and doing absolutely nothing. Let me show you what he sees that most people miss. Here is what actually caused this crash. And I want to be precise about this because the mainstream narrative is dangerously incomplete. The Federal Reserve held rates at 3.50 to 3.75% this week. They did not cut. They did not hike. They sat on their hands. But Jerome Powell's press conference sent a clear message. Inflation is not going away. The producer price index came in at 3.4%, above the expected 2.9%. Oil is trading above $112 per barrel. The US-Iran conflict that started earlier this year has sent energy costs spiraling, and oil feeds into everything: fertilizer, plastics, logistics, manufacturing. The Fed is trapped. Rates cannot come down without stoking inflation further. Rates cannot go up without triggering a deeper equity sell-off. And what happens in that trap? Investors panic across the board. They sell what they have profits in. And for the last 2 years, a lot of those profits have been sitting in gold miners, silver miners, royalty companies like Wheaton Precious Metals and Royal Gold. So they sold them, not because the thesis broke, because they needed liquidity. This is the single most important concept I can give you today. Ted Oakley put it perfectly. In a market sell-off, people do not sell what they should sell. They sell what they can sell. Agnico Eagle is down. Alamos Gold is down. Hecla Mining, one of the premier silver producers in North America, dropped from near $30 per share to below $20. And the reason is not that silver's structural story changed. The reason is that these stocks had massive profits sitting in them, and scared investors needed to raise cash. This is flow-driven selling, not thesis-driven selling. And that distinction is everything. Now let us talk about what the physical market is actually doing, because this is where the story gets extraordinary. Stay with me here, because what I am about to show you is the data point that changes the entire picture. COMEX registered silver. That is the silver sitting in exchange-approved vaults that is immediately available for delivery against futures contracts, has been draining at a historic rate. In just the first week of January 2026, 33.45 million ounces of silver were physically withdrawn from COMEX warehouses. That is 26% of registered inventory disappearing in 7 days. By February 11th, registered inventory had fallen below 98 million ounces, crossing below the 100 million ounce threshold that market watchers had been monitoring for months. And here is the leverage problem that nobody on mainstream financial media is talking about. The March 2026 futures contract alone represented over 528 million ounces of paper exposure, against roughly 103 to 113 million ounces of registered silver. That is a paper to physical ratio of approximately 7 to 1. 7 paper claims for every single ounce sitting in the vault. Think about what that means. If even 15% of contract holders stand for physical delivery, a completely reasonable assumption during a stress period, the math does not work. The metal is not there. And now the price is down. Do you see what is happening? The paper market crashed silver from over $100 back towards $70, but the physical demand that caused this stress in the first place, it did not disappear. Shanghai premiums continued to run above Western spot prices. Lease rates continued to signal backwardation, a condition where near-term silver costs more than future delivery silver, which only happens when physical supply is genuinely tight. The price is lower. The tightness is the same or worse. As one analyst put it, this is a magic trick. The paper price is performing one show, the physical market is performing another. And eventually, not if, when, those two shows converge. I want to give you the broader context so this does not feel abstract. Silver has now run consecutive structural deficits for 5 years. Annual industrial demand consistently exceeds 1 billion ounces per year. Annual mine production runs roughly 830 million ounces. The gap is not closing. In fact, it is widening. Solar panel manufacturing alone consumed over 200 million ounces of silver in 2025. Solid-state battery development, with BMW partnering with Samsung for next-generation evaluation vehicles later this year, may require up to 1 kilogram of silver per battery pack, compared to 25 to 50 grams in today's lithium-ion vehicles. The industrial demand story that powered silver's 135% move in 2025 did not stop when the paper market crashed. It accelerated. And what about central banks? The gold narrative here is critical because gold and silver move in a connected ecosystem. As SP Angel Metals analyst Arthur Parrish explained this week, the first leg of gold's multi-year bull run was driven by central bank accumulation, nation-states buying physical gold after watching Russia's assets get frozen in the early part of this decade. That money is not going away. What left the market recently was the second wave. Generalist funds, systematic hedge funds, and retail momentum traders who came in late and are now heading for the exits. Parrish called them the tourists. And he made a point that every silver holder needs to hear. The tourists leaving is probably exactly what is needed for gold, and by extension silver, to take another leg higher. The hands that were always going to sell at the first sign of trouble have now sold. What remains is structural. Now let me bring this back to something tactical, because this is where I think the source of most confusion lies right now. Investors are watching their mining stocks down 30-35% from the highs and wondering if they made a mistake. Ted Oakley's framework gives us a clear answer. He and his firm have 45 to 50% in short duration treasuries, 3 months, 6 months, up to 2 years, specifically so they always have capital available when prices drop. And this week, with miners like Hecla below $20 and royalty companies like Wheaton Precious Metals off 30 to 35% from highs, he started deploying that capital. He did not go all in. He described it as buying pieces, starting positions, taking advantage of the forced liquidation that produced prices that have nothing to do with fundamental value. The gold to silver ratio at 64.6 confirms what the data already shows. At the 2011 silver peak, that ratio compressed to 32 to 1. At the 2020 pandemic crash, it blew out to 120 to 1 before silver went on a historic run that dwarfed gold's performance in the following months. 64 is not a stretched ratio by historical standards. It is a ratio that in prior cycles has consistently preceded silver outperforming gold by a factor of 2 to 3 on the upside. I am not telling you what silver will do. I am showing you what it has done at similar setups and letting you draw your own conclusions. If you have found this analysis valuable, hit that like button right now. It genuinely helps this channel reach more people who need to see this data. Let me be direct with you before we close, because I think people watching this crash need to hear something honest. Every individual has to assess their own circumstances, their own risk tolerance, and their own investment timeline. This is not financial advice. I am sharing what the data shows the same way I always do. What I can tell you is that the structural case for silver, the industrial demand, the consecutive supply deficits, the COMEX inventory dynamics, the central bank accumulation in gold, none of that was dismantled by this crash. The tourists left, the oil shock rattled markets, the Fed gave no answers, and in the chaos, forced sellers took miners from $30 to $20. Based on the historical pattern of how these flush-out corrections resolve, my analysis suggests the next meaningful move in silver mining shares will be higher, not lower. I believe we see Hecla back above $25 before the end of the second quarter. I believe the gold to silver ratio is on a longer-term path toward 45 or below. I believe the physical demand destruction that would be required to break this thesis simply is not happening. If you want to share this video with someone who is watching their mining position bleed right now and does not understand why, do that now. They need the context, not the fear, the context. There are 3 types of people watching this video right now. The first type is scared. They are watching the red numbers and fighting the urge to sell everything. The second type is confused. They believed in silver's structural story. The paper market is telling them they were wrong and they do not know who to trust. The third type understands exactly what is happening. They know the difference between flow-driven selling and thesis-driven selling. They have liquidity ready, and they are watching this crash the same way a serious buyer watches a sale, not with fear, but with a list. Which type are you? Drop it in the comments right now. And while you are down there, what is your silver price target for the end of 2026? I want to see the range in this comment section. If this video gave you a clearer picture of what is actually happening, subscribe and hit the notification bell so you never miss when the data shifts. I will be watching the COMEX reports, the lease rates, and the miner positioning every single day. And when something changes, good or bad, you will hear it here first.